Hello and welcome everybody to today's presentation, part of our national webinar series. Today's topic is popular real estate investing strategies using a self-directed IRA. My name is Patrick Hagen. I'm going to be the presenter today, and I appreciate you taking the time to join us. I'd like to point out a couple things as we start. First off, if you're having any technical difficulties, if you can't see the slides move, or if you're not hearing my voice well, please type that in and we can address that. Secondly, if you have any questions at any point throughout this presentation, please feel free to type those in. This is an open forum, an opportunity for you to ask questions to us to get information about self-directed IRAs. So I'm going to cover the content. I'm going to go through the presentation slide by slide. But if there's anything that I say that doesn't make sense or anything that you're looking to get out of this that I possibly don't address, please type that in. I'll take time at the end to make sure that we answer all the questions that the attendees have. We have to start with the disclaimer. With all presentations that we give, this disclaimer is critical, and I'll read it to you. The Entrust Group, Entrust, does not provide investment advice or endorse any products. All information and materials today are for educational purposes only. All parties are encouraged to consult with their attorney, accountants, and financial advisors before entering any type of investment. This is built into the self-directed premise. We'll talk in a moment here about what self-directed means, but it basically means the client, you, if you're the client, control everything that transpires on the account. So as administrators, we're simply taking your orders and doing what you specifically tell us to do. But we're not telling you what to do. We're not giving any investment advice. This is a critical piece that you need to understand in order to get your head around the entire self-directed IRA process. Today's agenda, I'm excited about the presentation today. I think it's going to be a great topic because we have a lot of people that are interested in buying real estate, but they can't quite understand what their options are, different ways to structure deals, and how the actual process works. So we'll talk about that in a nutshell. We'll talk about who the Entrust Group is. We've been doing self-directed IRAs for over 31 years. I'll tell you a little bit about our group. We'll touch briefly on the current state of retirement plans in the U.S. I think it's important to note because there is a bit of a crisis coming down the pipe in that many Americans are not properly planning for their retirement, and they're going to get to a stage to when they may not have the option that they have currently in their life right now. And so we'll talk about where people are at right now and maybe the need for people to spend a little more time thinking about their retirement and maybe ways that they can better prepare themselves for that future retirement date. We'll talk about what a self-directed IRA is. This is a term that gets thrown around quite a bit, and sometimes people understand what it means and sometimes they don't. So we'll talk about what a self-directed IRA is and how it's used specifically towards buying real estate within that self-directed IRA. We'll talk about the different things that our clients are doing, real estate primarily as a primary asset we're going to talk about today, as well as a few other things that we see our clients do. We'll talk about the popular real estate investment strategies. We have slides on 3 strategies today, but I think I'll probably encompass at least 5, and we can talk potentially about more if the questions dictate that. We'll talk briefly about the rules. We have a lot of presentations that talk about the rules. There are some very specific rules for IRA and 401k investing in real estate, and we'll cover those. And then a couple of due diligence tips, things that you should potentially consider doing if you're going to self-direct your retirement funds into real estate or some other alternative asset. So first, let me tell you a little bit about the Entrust Group. Our firm has been in business for over 31 years in the self-directed IRA space. We currently have over 15,000 clients and nearly $4 billion in assets under administration. Our staff is based out of Oakland, California, is where we have our primary operation. We have a very knowledgeable staff, people that have been doing this a very long time, that have been trained and equipped to administer these types of plans very efficiently and smoothly. We fund a couple thousand transactions a month. I think the last time I saw the numbers, it was 12 to 15,000 transactions per month. So very high volume, a lot of activity. And one of the things that makes us unique is that we do have offices regionally throughout the country. And so you can check out our website and find the local office or the office that's closest to you. We should have at least one office in your time zone. You can call that rep and get information, ask questions, talk about a potential transaction. That gives a little more of a one-on-one connection to our clients and prospective clients, and I think it's a valuable tool, and I encourage you to use it. We have trained and equipped the people that we put in the field to be able to handle any questions that come in, and we like to spend our time and share the information that we've gathered over the last 30 years of doing what we do with our prospective investors. We also provide education. We do continuing education courses and other courses to CPAs, attorneys, financial advisors, as well as presentations to investors and webinars like we're doing today. Quick overview of the current state of the U.S. retirement. This is something that we didn't really harp on very much in the past, but it's something that we've kind of built into our presentations because I think it's an interesting statistic, particularly the first two line items there, that in 1991, which was roughly 22 years ago, 50% of workers expected to retire before the age of 65. 11% expected to retire after the age of 65. So now 22 years later, 2013, that number has been reduced by more than half. 23% of workers expect to retire before the age of 65, and 36% of workers expect to retire after the age of 65. At the moment in this country, over 30% of households have less than $50,000 saved for retirement, and nearly half of U.S. workers are not confident that they're going to retire comfortably. Now, we put this in there not to try to advise as to how to solve this problem, because that's not what we do. We're not advisors. We don't tell you what to do with your retirement plan. We put it in there simply to bring to your attention the fact that this is something that needs to be addressed, both on the macro level and on the micro level. Countrywide, as well as individual households need to consider, if retirement is something that you're moving towards, what are you doing to get to that point? How do you take the steps today to get to the point that you need to be so that somewhere down the road you can potentially retire and retire comfortably? So again, with the self-directed piece, what we're going to talk about is holding alternative assets, using your tax-deferred money, your IRA or 401k funds, or other tax-advantaged funds, and putting them into alternative assets like real estate or other things like private placements, private notes, or precious metals. This is something that unfortunately right now is a very niche industry. It's something that a lot of people are not all that acclimated towards. They don't understand that you can even do it in some cases, and if they do understand that you can do it, they maybe don't understand how you can do it and what the steps are involved in the process. So we put together these presentations not to tell you what to do with your retirement plan dollars, but rather just to tell you that you have options, and we want to clarify what those options are. And it's a good opportunity for you to ask questions, for me to provide some information, and hopefully you walk away with enough information to where if you want to do this with your retirement plan, you feel comfortable and capable of self-directing. So what is a self-directed IRA? Self-directed is a descriptive term that we use and that the industry uses to describe the type of retirement plans that we provide administration for. And primarily a self-directed IRA is used to invest in non-traditional assets. So if you think about IRAs and 401ks, you typically think of traditional investments being stocks, bonds, mutual funds, maybe ETFs, those types of standard investment products. A self-directed IRA allows the client to control their own retirement plan and invest in basically whatever they want. Now, there are some restrictions of things you cannot invest in, and we'll touch on that in a moment, but the opportunity is much more vast than most people realize. You are not limited to stocks, bonds, and mutual funds. Some institutions may limit you to stocks, bonds, and mutual funds if that's the only products that they allow. But from an IRS standpoint, as far as what an IRA can take part in, it's actually very flexible. And we have had clients over the last 31 years buy investment real estate, buy stock in private entities, buy metals, precious metals, gold, silver, platinum, and palladium, private notes, those types of things. So these have always been options. The key is you have to find somebody that's willing and capable of administering the account that is holding these assets. And that's where Entrust comes into the picture. This is the space that we specialize in, is the self-directed IRA space holding alternative assets for clients that want to self-direct their retirement plan. So the opportunity is expanded into more than just stocks, bonds, and mutual funds. The key, the last point there is that IRAs are all regulated and governed by the same set of rules. I like to explain that to people because a lot of times the term self-directed can confuse people. They hear self-directed and they assume that the IRA is somehow different at its core, and it's really not. An IRA is an IRA. If you have a traditional IRA right now and you want to move that to a traditional IRA with us, you can do that, and the essence of the IRA is still a traditional IRA. Nothing changes other than the flexibility of the administrator that's providing the record keeping for that IRA. So a Roth is a Roth, a traditional is a traditional. That's the same across the board. The only distinction with self-directed is that you are controlling what transpires within that account as opposed to paying another firm to invest it for you. And most companies that hold retirement plans are in the advisement industry. They provide investment advice, and as a result of that, they typically limit their clients to the products that they can sell, which ends up being publicly traded securities, stocks, bonds, mutual funds, those types of things. And unfortunately for us and for a lot of investors that want to do this type of thing, they've never really been aware of the fact that it's an option. For 30 plus years we've been told IRA 401k equals stocks, bonds, and mutual funds, and that's just not the case. That's obviously the biggest piece of the puzzle. That's what most people have their retirement plan wealth in currently, but you do have options, and we want you to know that you have options and understand what those options are. The benefits of a self-directed IRA is that you can invest in what you know. If you know and understand real estate and want to build up your tax-deferred wealth with buying and selling real estate, you have the option to do that with a self-directed retirement plan. Diversification is another key advantage. Everybody talks about diversifying the retirement plan. Everybody knows that you don't want to put all of your eggs in one basket. You want to spread the wealth into different types of investments. However, most people diversify all within the confines of publicly traded securities. So you may be diversified in the stock market, but if the entire stock market takes a dip, like it did in 2008, chances are most of your wealth is going to take a dip as well. Diversification is when you have assets in different pockets. One of those assets may be something alternative, like a piece of investment real estate or something else that our clients do. The tax advantages are clear. If you're investing through a retirement plan, you have built-in tax-deferred growth on all of your investments. So if you buy something for $50 and sell it for $100, you don't pay any capital gains. If you buy something for $50,000 and sell it for $100,000, same principle. That's true whether you're buying real estate through a self-directed plan or whether you're buying stocks and mutual funds through your brokerage company. So basically it just expands your horizons a little bit, gives you different alternatives other than just stocks, bonds, and mutual funds. What can I invest in? The key to understand here is that the IRS doesn't actually give a big long list of what you can do. What they tell you cannot do is life insurance and collectibles. Those are two investments that are specifically deemed disqualified. So if you wanted to take your retirement plan and buy life insurance or collectibles, you would not be able to do that. But other than life insurance and collectibles, basically the sky's the limit. We have clients that buy an array of things from real estate to ownership shares in a limited liability corporation, limited partnerships. We see people that lend money through their retirement plan through secured or unsecured notes, joint ventures, trust deeds, precious metals. I've had clients buy all kinds of crazy things like farmland and trees and racehorses and just all kinds of unique stuff that you would never really think of as a viable IRA or 401k investment. But when you look at the rules say you cannot buy life insurance and cannot buy collectibles. But anything else that you're buying that's held as an investment is probably allowable for a self-directed IRA to get involved in. Today's presentation is on real estate. That's what I'm going to spend the majority of our time focused on. Now, a couple of quick rules before we dive into the actual case studies of the different strategies that we see people use. It's very important to understand that you're not allowed to do business with yourself or your direct lineal family members. Now, these people are defined as disqualified persons. You can find this list in Section 4975, and it states very clearly that it's basically the account holder as an individual, their spouse, their parents, grandparents, children, and grandchildren, as well as anyone who has a fiduciary relationship with that IRA account holder. So if you kind of look at yourself and draw a line north-south, those people are called disqualified parties, disqualified persons. Those people cannot do deals between your IRA and those people. So right now, as an example, if you have your mother that owns a property right now that's in her name, if she wanted to sell that to your IRA, that would not work because your mother is a disqualified person, thereby she cannot have transactions with your retirement plan. Likewise, if you own a property right now, you're not allowed to shift that or move that into your retirement plan. And this is called self-dealing, and it's a very clear prohibited transaction. It's something that comes up quite a bit in conversation. We are basically just explaining the very clear guidelines that the IRS has provided in this respect. This is not an Entrust rule. This is an IRS rule in respect to what you can do and what you cannot do through a retirement plan. So direct lineal relatives are people that you cannot have transactions between. You cannot buy and sell, exchange or lease, rent properties to these folks. These are people that cannot have dealings with your IRA. Now, I wanted to put this in there today because in a moment we're going to talk about one of the investment options, one of the strategies that we see is partnering IRA money with other individuals. And this trips people up from time to time because we talk about the fact that you cannot have dealings with disqualified persons, which is absolutely true. But you could, in some circumstances, partner on a new investment in a new project alongside one of these people. And we'll talk about that in a moment. But when I talk about doing transactions, that would be a buy or sell, exchanging or leasing between a disqualified person and an IRA. That doesn't work. That's a prohibited transaction and is not allowed. But in a moment, like I said, we'll talk about partnering and how that could potentially take two different pools of money and get involved on a new deal. But again, these rules are in place. They have been in place since IRAs were created. When you look at these rules, you don't really want to find a way around the rules. You want to understand what the guidelines are and then play within those guidelines because, again, there's not a lot of flexibility with how this works. Now, you'll notice that this defines people on kind of a lineal basis, ascendants and descendants of the account holder. This does not include kind of horizontal. If you think of your siblings, aunts, uncles, cousins, neighbors, friends, those types of people, they are not defined as a disqualified party. So technically speaking, if your brother owned a property and you wanted to buy that property with your IRA, that would not be a prohibited transaction because your brother, by definition, is not a disqualified person. Same situation with your aunt or your uncle or anybody else who's not a direct lineal relative. It's you, your parents, your grandparents, children, grandchildren, your spouse. Those and spouses of descendants. Excuse me, I should point that out too. So basically, if you have children that are married, your son-in-law or daughter-in-law would also be a disqualified person, and you could not have dealings with these people. These people cannot buy and sell between themselves and your IRA. They can't live in the property that your IRA is buying. So you wouldn't be able to buy a condo, for example, and rent it to your mother or to your daughter or to somebody else who's a disqualified person. So if you have any questions on that, go ahead and type those in, and I can answer them as we get to the question and answer portion of the presentation. But I'd like to move forward. We've got three popular real estate strategies. I've got slides on three. I'm actually going to talk in total about 5 different strategies, but there's 3 that we've kind of isolated and put together a presentation for today, and I think they're unique strategies that you're probably going to be interested in. First thing that I want to touch on is kind of the overarching strategy. The primary strategy of buying real estate is taking a retirement plan and buying the property outright, and that's what we consider a real estate IRA. Real estate IRA, again, is like self-directed. It's a descriptive term. It's not a formal term by any stretch. It's just a way of defining an IRA that's invested in real estate as opposed to invested in stocks, bonds, mutual funds. So again, we talked earlier about that being a viable option for your retirement plan. The term that we use is a real estate IRA. If you have money in a retirement plan with another provider and you would like to move some of that over to an account with us, a self-directed retirement plan, you could do that and then through that account buy and hold real estate. That would be considered a self-directed IRA that's invested in real estate. So when we talk about strategies, that is the most popular strategy. Most of our clients that are buying real estate are buying the entire investment through their retirement plan. The deed clearly lists the one owner as the individual retirement plan. Now before we started, somebody typed in a question about how is that titled? How is the actual, what does the contract language look like? What does the warranty deed read in respect to a purchase in real estate? Well, it's in the name of your retirement plan, which in this case would be administered by the Entrust Group. So if John Doe were to set up an account with the Entrust Group and he was going to buy a piece of real estate directly and purchase and hold that property as the sole owner through the retirement plan, the deed, the contract all the way through the deed, is going to be in the name of the Entrust Group, FBO, which stands for the benefit of, John Doe, IRA number 12345. It's John Doe's IRA that's held with the Entrust Group, administered by the Entrust Group. So you can plug your name in there if you want to get an idea of what it's going to look like. The Entrust Group, FBO, your name, and the account number that we assign you when you set up the account. So the standard way to buy real estate, 100% owned by the IRA as the sole owner. Everything flows through the retirement plan from start to finish. Another strategy that we've seen, and this is strategy number one for the sake of our presentation, is partnering your IRA. Now, I've been doing this now for about 9 years, and I've seen a lot of different creative structures, and this is something that I've seen quite a bit of. And it's an interesting approach because IRAs, as you probably well know, have certain contribution limits. So it's something that you build up over time. So we find often that people are looking to buy a particular investment, but they may or may not have the amount of money that they need in their retirement plan at this time to acquire the entire property. Maybe there's $100,000 in an IRA and the property is $150,000 or $200,000. So we're going to talk about some different ways you could potentially do that and get a smaller account in on a bigger investment. And one of the ways that we've seen is by partnering IRA funds with non-IRA funds. So this is a strategy which people basically team up, pool their money together into one investment that they're going into at the same time on split ownership. So the actual purchase of the property is going to show the percentage breakdown between the multiple parties that are going into the investment. So it could be a 2-person split ownership. It could be a 10-person split ownership. It doesn't make any difference from our standpoint. That's between you and the people that you're partnering with on the deal. Where we get into the picture is that we're going to see when you're buying this property what the property is and how much of the property your IRA is going to own. So it may be that your property is going to be owned 100% by the IRA, or it may be that your IRA is going to own 50% or 30% or whatever it may be. The partnering allows an IRA to be an owner in the property without necessarily owning the entire property. And again, that may give you the opportunity to get a smaller account in on a bigger investment that otherwise you wouldn't be able to do by yourself with the money you have available in your IRA. It's very important that once you go into this on split ownership, that whatever percentage you own on day one remains consistent for the life of the investment. So if you go into a new investment and you own 50% of that investment, then 50% of the money that's coming to close on that investment is coming from your IRA. When an expense comes up, 50% of that expense bill is going to be paid by your IRA. When there's income, 50% is going back into your IRA. And it doesn't have to be 50. I use that as an example. It could be whatever percentage you decide fits for that particular situation. So again, it's a split ownership, typically done as tenants in common is typically how you see the language reading on the deed. So it may be John Doe as an undivided blank % interest, and the Entrust Group for the benefit of Stan Smith as to an undivided blank % interest. So it's, again, split ownership where multiple parties are going into the same investment at the same time. Let me touch on two things here of examples of transactions that do work, and then I'll talk about avoiding some prohibited transactions. Now, we talked about the disqualified persons, and those are people that you cannot have transactions with, so you can't buy and sell between those people. However, this strategy of partnering can be done technically with anybody, including yourself or a different disqualified person. So I mentioned earlier, if my mother owns a property right now, she cannot sell that to my retirement plan because that's self-dealing, as my mother is a disqualified person. However, if I wanted to take my IRA money and partner with my mother on a new investment at the same time with very clearly established split ownership, we could do that into that same investment at the same time. My IRA would own 1% of the property, my mother would own 1% of the property, and we would keep everything split proportionally for the life of that investment, from contract all the way through to the deed, including the operating costs and expenses and income down the road. So you could partner with yourself on a deal. You can see that first line item there is partnering with yourself. So again, I'll keep the math simple. Let's say the property is $100,000. You have $50,000 in, say, a Roth IRA, and you have $50,000 of personal cash. If you want to partner your IRA, which is one entity, with yourself, which is technically a separate entity, into that investment at the same time, you could do that. The deed and the contract and everything involved would show the split ownership, and then you would keep that consistent for the life of the investment. Now, it's very important if you're going to partner with a disqualified party that you don't jumble up those percentages after the fact. If you go in 50-50 or 80-20 or whatever it may be, that needs to remain consistent for the life of the investment. It's very important. You can see also that you can partner with your cousin. Now, cousins are free game because they're not disqualified persons, so you can partner with a cousin and that would not be a problem. You could partner with your spouse. That's kind of like partnering with yourself. Your spouse is a disqualified person, but as long as the percentages are clearly established at the beginning, you can keep everything proportionally split. That works fine. And then the last is leasing to a sibling. Sibling's not a disqualified person. One quick point here, actually I'll move to the next slide, which is avoiding prohibited transactions. It's important to understand that the rules that apply to the IRA will apply to the entire investment that the IRA is a part of. I've had people from time to time that have proposed the idea of buying half the property with their IRA and half personally with the intent of using their personal percentage. It doesn't work like that. If your IRA is involved in any capacity, you cannot use that property or have any benefit from that property. That includes you or any other disqualified person. So you wouldn't be able to either sell, exchange, or lease between those people, and you wouldn't be able to use that property if your IRA is involved. So there's a couple of things. This is just general overview, prohibited transaction avoidance. You don't want to borrow money from a disqualified person. You don't want to sell property to a disqualified person. You don't want to use the IRA as security for a personal loan, and you don't want to buy property with personal use through the IRA. So again, you can split ownership, you can do different stuff within the IRA, but you want to avoid these prohibited transaction issues. And if any of this doesn't make sense, if you have any questions on any of this, feel free to type that in and I'll make sure to leave a few minutes at the end for us to cover the questions that come up with split ownership, because it's something that I understand why people have a difficult time understanding it, because on one hand, we're saying you can't do business with your direct linear relatives or yourself, and then we talk about partnering, and you can partner with direct linear relatives or yourself, and it seems a little bit confusing. But again, the difference is you can't have dealings between disqualified persons and your IRA. But on a new deal with split ownership that's clearly established, you could go into that new deal with a disqualified person or other person, and that would work. Now, for an IRA purchase, we talked earlier about how the IRA is listed as the purchaser. If you're a client of the Entrust Group, the vesting is going to read the Entrust Group, Inc., FBO, your name, IRA, and the account number. If there are more than one party involved in the deal, then there's going to be a percentage breakdown. So it would be the Entrust Group, FBO, your name, IRA, and the account number as to an undivided blank % interest, and then the partner as to an undivided blank % interest. As mentioned before, the rent as well as the expenses are then going to correspond with those pre-established percentage breakdowns. So if you own 50% of the property and there's an expense, the IRA is going to pay for 50% of that expense. Same thing with income coming back. If you have any questions about that, again, we'll take time at the end and we can answer those questions. But that's investment strategy number one, is partnering IRA funds to make an investment. Strategy number two is leveraging the investment through the IRA. Now, this is something that's very unique, and I think it's exciting because it allows you to potentially buy something that's larger than what you could do in just your retirement plan alone. This is a method by which people could use an IRA as a down payment on a property and finance the balance of the purchase. Now, in order to do this, you have to get a special type of loan, and that special type of loan is called a non-recourse loan. Let me kind of explain what that means and how it's relevant, why it comes into the picture. Typically, when you go to the bank and you finance a property, the bank's going to want to see two things. They're going to want to see what is the value of the property and underwrite the deal itself, and they're also going to want you to personally guarantee the loan that they're giving you. So they're going to look at your credit. They're going to look at your personal financial statement. They're going to basically underwrite the loan based on the deal itself as well as your strength as a guarantor on that deal, because when it's all said and done, you're going to sign on the dotted line promising to repay the bank for the money you're borrowing. With a non-recourse loan, the bank is lending to your retirement plan, and the rules very clearly say that you're not allowed to personally extend credit on behalf of your retirement plan, which in layman's terms means you can't sign a personal guarantee for a purchase that your IRA is making. So when the bank underwrites the deal, they're still going to look at the appraised value of the property. They're going to figure out whether or not there's going to be enough money coming in with rent based on the market conditions and everything else, but they're not going to have you as an individual personally guarantee the loan. Basically, the bank is lending to your IRA secured exclusively by the property that the IRA is purchasing. So that's what makes it non-recourse, is that the bank's collateral is the property, just like in any other deal, but they don't have a personal guarantee to fall back on if something goes south. So in order to find a bank that's willing to do this, first off, you have to find a bank that kind of looks outside the box a little bit, a bank that maybe isn't doing just your standard run-of-the-mill commercial deals, but is willing to look at some unique investment strategies and different deals. We have a list of non-recourse lenders. In fact, I see a question coming through right now. We've got a list that we can provide. I'll give you my email at the end of the presentation. I'd be happy to email that list to you, or we can have corporate send it to you. It's not an exhaustive list. I'm sure there's other banks out there that do non-recourse loans, but we try to compile a list so that when our clients are looking, they have a starting point. They have a list of names of banks that do these deals, so you're not just shooting in the dark hoping to find one of the few lenders that do these non-recourse loans. So we can share that with you. The other thing to understand with these is that they're done on a case-by-case basis. The bank is going to underwrite the deal as an in-house portfolio loan that they're going to keep on the books. And in order to get a bank to do this, generally speaking, they're going to require a slightly higher down payment from the IRA than maybe they would get if you were buying the property and personally guaranteeing it. Typically what we see is the bank's going to require between a 30 to 35% down payment. So your loan to value is probably going to be somewhere in the range of 65% LTV on the property. You're going to finance the balance, but the bank is going to require a higher down payment. Now they do that because without your personal guarantee, the bank wants to know, okay, if this is my only collateral, this property is all I have, if this deal goes south, then I want to know, is there enough equity in that property to then liquidate the investment and pay off the loan? And so in order to kind of solidify that, they will generally require a slightly higher down payment than what you'll see in a normal deal. Now, that's not to say you might find a bank that might be a little more flexible on certain deals, but that's between you and the lender to establish all that as far as what they're going to lend, what the rates are going to be, down payment requirements, everything involved in the non-recourse loan is really between you and the IRA. Between you and the bank. The bank is going to be the one that's going to dictate all that. Now, a couple of just real-world issues that come up with bank financing. Typically, the process of acquiring the property is a little bit slower when you get a bank involved. I think that's standard in any investment, whether it's with an IRA or not. But the bank's going to want to do their standard underwriting. They want to get an appraisal on the property. They want to analyze the deal. They want to make sure everything works. They'll get a survey and all that stuff. A lot of that doesn't come into the picture if you're just buying for cash with the IRA. If you're buying for cash, you're ready to go. The seller's ready to go. We're ready to go. It can happen as short as 2 to 3 days. If you're buying real estate with debt and you're encompassing a bank loan, it's going to take a little bit longer. Typically what I see is about 30 to 45 days for the bank from start to finish to get all their ducks in the row ready to close on that property. And so I think that's standard. Anytime you bring a bank into the picture, they have their standard underwriting. It's going to slow things down a little bit. So you're probably not going to do quick turns, fix and flips, that type of stuff with leverage. But if you're looking to buy something and hold it for a period of time and you'd like to utilize leverage to do it, it's a neat feature that it's out there that you can finance, and there are banks that do these non-recourse loans, which could potentially, again, expand your buying power and allow you to buy something that's bigger than what you could do with just a cash in your account. So it's something to consider. That's real estate strategy number 2, is leveraging your investment through a non-recourse loan. Strategy number 3 is real estate options. Now, this is something that's very unique, and I think it's worth touching on because it's something you could do with a smaller balanced account. If you're going to buy a property for cash, and that property is $100,000 for a listing price, you really need $100,000 to buy the property. If you're going to buy the $100,000 property and finance it, you need to find a bank that's willing to finance it. With options, you could potentially put up a smaller amount of money as an option to purchase and then either take that time to figure out exactly how you're going to acquire the funds to purchase and close, or you could potentially sell the option to the property. This is something that we saw back in Florida in 2003, 2004 when the market was really hot. We saw a lot of investors going out, locking in the investment with an option to purchase at a specified price, and then potentially turning around and selling that option as an asset to an unrelated party at a gain, so more than what they paid for the option. So it's an opportunity to potentially do that, or it's an opportunity to lock in a deal now with the option to purchase at a specified period of time, and then gives you the time to basically figure out, do you want to buy it with cash? Do you want to finance it through a non-recourse loan? Do you want to bring in a partner and buy it on split ownership? It gives you the opportunity to potentially figure all that out before you actually go to the closing table at some specified date down the road. So again, this is a strategy that we've seen people use. I don't want to say it's exclusively for smaller accounts because it's not. You could do it with a larger account. But I think it's a unique investment strategy for a smaller account because you don't need quite as much to buy the option to the property as you would maybe to close on the property with cash on the day that you put in the deal. So it's something that we've seen. It's kind of a unique strategy along with partnering and leveraging and buying directly. The other strategy, which we did not put a slide in for today, is buying through an LLC. And it's something that I won't spend a whole lot of time on today because we have other presentations that cover this a little bit more in detail. But we do have investors that instead of buying their property outright through a retirement plan and coordinated with Entrust on everything from start to finish, will take their IRA with us, put it into a newly created LLC, one which their IRA owns and which they then become the manager over, and then they'll go out and make investments through the LLC. So that's a strategy that is particularly advantageous for somebody that's looking to do something very time sensitive. If you're going to buy properties at auction, if you're going to buy tax liens, if you're going to do quick turns, fix and flips, those types of things, sometimes an LLC will alleviate some of the built-in time restrictions that you have with encompassing the IRA administrator. Now again, we move pretty quickly when our clients are ready to make an investment, but there's a lot that goes into an investment. So if somebody calls us up on a Tuesday morning and says, hey, I need you to wire $100,000 this afternoon, we can't quite work that quickly. There's way too much that goes into a closing for us to drop everything and just arbitrarily wire the money. We have to see all the documents. They have to be approved. We have to make sure everything's in order. And then you have the logistics of getting the wire out the door. With an LLC, from our standpoint, all the client has is an investment in an LLC. The day-to-day administration is handled by the manager of that LLC, which is you or somebody you appoint. You then will have quicker access to your money to then go out and do things very quickly if you needed to without involving our transaction department on anything that you're doing. So we didn't talk about that specifically, but I wanted to throw it out there because we get a lot of questions. A lot of people look into that as an option. We don't necessarily recommend it or push people into that investment because we don't recommend anything as a self-directed advisor. It's all our self-directed IRA administration company is all controlled by you, but it is an option. It is something that some of our clients have done, and for some people it tends to work very well for them because it gives them immediate access to their money. So between those strategies, again, buying directly for cash, buying with split ownership, buying with leverage, buying options, or buying through an LLC, hopefully we've touched on some of the potential options, potential structures that you could look at using to buy and sell real estate with your tax-deferred wealth. Now, a couple things about due diligence. Again, you're going to want to do all the due diligence on the deal. Entrust does not do due diligence on your deal. Quite frankly, if a client's directing us to facilitate an investment, we don't know if it's a great investment or if it's a terrible investment. All we know is that the client is directing us to process that investment. All of the due diligence is handled by you and your team of consultants that you work with. Your real estate professional, your real estate attorney, title company that you're working with, potentially your CPA if you'd like to get their involvement. But you're going to want to make sure that everybody's on board, everybody's looked at this, and you have decided that, yes, this is something that I want to do with my retirement plan. Because, again, it's all self-directed. You are the self in the self-directed IRA. You and the team that you put together with the professionals that you choose are going to determine what you do, how you do it, and when you do it. We're simply here to facilitate what you do when the time comes. Quick, easy steps if you decide you want to go down this path, if this is something you're interested in doing. First step is to establish an account with Entrust. That takes about 2 days to open an account. You complete a simple application, which we can send to you. You complete it, send it back to us. We'll open up a new account. Second step is to get money into that account. Typically that's going to be done with either a transfer, a rollover, or a contribution. That's getting money into your account with Entrust, and then from there you can figure out what you want to purchase and direct us to process that purchase. Standard transaction time for a real estate purchase, about 2 to 3 days. That's if you provide everything to us, everything looks good, it's about 2 to 3 days for us to close on that property. Now, I've got a whole bunch of questions. I didn't mention this at the beginning, but we have a very large audience today, and just for the sake of time, I want to see if I can buzz through a few of these questions very quickly and get some answers out to the people, because these are good questions, and this is an open forum, and I want to see if I can address as many of these as possible. So I'll put my contact information up there. We're not quite done yet because we've got Q&A at the end here. If you need to go, this is being recorded. You can always shut down and get the recorded version later if time doesn't allow you to stay with us. But for those of you on the call, I'm going to take a few seconds to read these questions and provide an answer to you. Okay, let's see what the first question is. And thank you for all these questions. It looks like there's quite a few of them here, which is great. All right. First is, what is the carry cost charged by Entrust to account as the self-directed IRA administration company? What do we charge to do this? Basically, we charge a fee to administer the assets in your account. And there's two different options for how you're going to pay our annual admin fee. One option is to pay us an admin fee for each asset that you have with us, and that breaks down to $295 per asset per year. The other is based on the value of your account, whereas we don't look at the individual investments and the number of investments you have, but rather look at the total value of your account with us, and then we have a chart that you basically just plug in the number and it kicks off an annual fee. So you could look at our fee schedule to itemize those costs and figure out which option 1 or option 2 is going to be a better fit. We also charge a transaction fee. There's a lot that goes into buying and selling investment real estate. The fee that we charge to facilitate a purchase is $125. So if you're a new investor that's buying a piece of real estate, we will charge you $125 to close on that real estate, because there's paperwork, there's time, energy, and effort, and we need to be compensated for that time, energy, and effort. So typically it's $50 to open an account, $50 to open an account, $125 to acquire the real estate, and then either $295 for each asset or whatever the fee is based on the value of your account. And again, I defer to the fee schedule that's both on our website, and I could also email to you if that would be of interest to you. So that's a good question. Here's a question is, my wife and I both have a Roth IRA with Entrust. We're interested in partnering the 2 IRAs to buy a rental house or potentially a flip. Please suggest the simplest way to do this. Well, as I mentioned earlier with the partnering structure, that's a viable option. If you wanted to take your IRA and your wife's IRA and go into that same investment at the same time with split ownership, the 2 IRAs can be involved in one deal, and everything can flow between those 2 IRAs as the owner of the investment. So if it's 50-50, then the math is really simple. Everything's split in half. It may be 70-30 or whatever the numbers warrant, but you're going to make sure that the percentage breakdown is very clear from the beginning, from the contract all the way through to the deed, and then going forward with the operating income and expenses. So it's definitely an option. Another question is, this is a question about why real estate for an IRA, which is more of a philosophical kind of investment planning type question. Why would you buy real estate in an IRA? We basically defer that back to the client. It's all self-directed. This isn't necessarily for everybody. For somebody that doesn't know anything about real estate, it's probably not advisable to buy real estate within a tax-deferred retirement plan. But for somebody that does or has a desire to do that, we want you to know that it's an option. So we're not selling the idea of buying real estate. We're not advising, because we don't do that as a self-directed IRA provider. We're simply saying if you want to buy real estate, there is that opportunity, and we can facilitate the transactions on behalf of your retirement plan that you have with us. There's also a question there about a solo 401k. I don't have a whole lot of time to go into the solo 401ks, but those are unique products for people that are self-employed that have no employees. And it's an opportunity through the solo K to do a couple things. Primarily is your contribution limit is going to be significantly higher than what you could do through a standard traditional or Roth IRA. There's also some built-in features that individual Ks have that IRAs don't, like individual Ks allow you to borrow money from the individual K plan. There's also some tax benefits if you're going to buy property with debt. There are certain things that don't apply to an individual K that would apply to an IRA. For the simple sake of time, I can't really go over it a whole lot, but I do have a nice piece that I could send you via email on our individual 401k plans. So if you are self-employed with no common law employees and are interested in that, please shoot me an email to phagen@theentrustgroup.com, and I'll reply back with that individual 401k piece, and it summarizes all the features and the distinctions between the individual K versus a standard IRA. Let's see. There's a question about whether this presentation is going to be recorded and could they get a playback link, and the answer to that is yes. We are recording the presentation. Within a couple of days we will email you a link that you could play back the recording in real time and listen to the presentation and get the information that we talked about. So if there was something I touched on earlier in the presentation that maybe you want to go over again, you could listen to that. And to that point also, I want to point out that our reps in the field, our business development managers, that's what I am, and there's other people like myself with Entrust, we're available to answer questions for your situation. If you have questions and you want to run something by us and say, hey, this is what I'm looking at doing, how would this work, what are the steps, what needs to happen in what order, that's all stuff that we do on a regular basis. So feel free to use us as a resource. Call your local rep. Call me if you'd like to call me directly. I'm available. My assistant's available, and we can answer any questions you have. So the presentation today is to get the basic information out there, answer your questions that you type in. But I want you to know that you've got free access to us if you have any questions. That's what we're here for. We answer these questions. We get you the information. We don't tell you what to do. We can't tell you what to do. We can certainly amp you with as much knowledge and information as you can absorb, and then you can decide for yourself if it's a good fit for what you're trying to do with your tax-deferred retirement plan. Okay, a couple of technical questions, which I think we got taken care of. Okay, here's an interesting question. It says, what about a fiance who will get married in a year or two? This has come up a couple times in the time that I've been doing self-directed IRAs, and I looked into it a while back. And technically speaking, a fiance is not a disqualified person. By definition, they're not a spouse. Now, at some point, if they become a spouse, at that point they become a disqualified person. But take the fiance out of the picture. Let's just say it's a boyfriend or a girlfriend and make it a little bit less formal. If you wanted to buy a property that your girlfriend owned, you could technically do that with your IRA because your girlfriend, by definition, is not a disqualified person, assuming two things. One is that person, your girlfriend or your fiance or whoever it may be, is not the beneficiary of your IRA. When you set up an account with any IRA provider, you set up a beneficiary designation. That person, regardless of who they are, automatically becomes disqualified. So if I'm dating a nice young lady and we're doing well and I don't have any relatives I want to leave my retirement plan to if something happens to me, and I appoint her as the beneficiary of my IRA, she's automatically disqualified. Even though she is not a direct lineal relative and wouldn't be defined as disqualified otherwise, as the Benny in my IRA, she becomes disqualified. As far as doing deals with fiancés, boyfriend, girlfriend, that type of thing, again, the code says direct lineal relatives, ascendants and descendants, and spouses. Technically speaking, a fiancé is not a spouse. Now, keep in mind, if your boyfriend or your girlfriend or your fiancé buys a property with their IRA, or if you buy that property with your IRA, that person you got to follow the guidelines in respect to using the property. You wouldn't want a situation where your IRA bought a property, rented to your fiance, and you live there, because even though you're not on a lease, you're still using the property, so indirectly you're breaking some of the rules. So you get into a little bit of gray there, and we can kind of talk about that on a case-by-case basis, because it doesn't come up much, but it's an interesting question. Another question is, well, it looks like we answered that question about partnering already. Let's go to the next question. Okay, this one says, can I buy the home of my wife's parents' second home? So that would be your wife's parents. Okay, so go back to the direct lineal relatives. That's your ascendants and descendants of yourself, your spouse, and spouses of your descendants. So technically speaking, my mother-in-law, if I'm buying a property, technically she is not a disqualified person for me to buy the property from her. Now, turn the tables on that. I am a disqualified person from her IRA. So if you turn it around the other way, my mother-in-law would not be able to sell me a property because I am a spouse of her direct lineal descendant. So again, you kind of got to look at that and say which way are the arrows going and who would be disqualified in what situation. So you look at all the factors involved, who's involved in the deal, and would any of those people be considered disqualified parties based on 4975 of the code and that direct lineal relative issue. And if they would be, then you can't do deals with them. If they're not, depending on which way it's going, then you could potentially do a deal with them. But again, you want to look at that very carefully because those rules are set in stone. There's really not any gray in that. So you want to look and say, is this person, based on 4975 of the code, a disqualified party? And if they are, you can't have any dealings with them directly or indirectly. Okay, another question is, can I buy the home of my ex-wife's parents' second home? Which is an interesting situation, and the answer to that would be yes, you could, because first off, it's your ex-wife, so she's not your wife anymore, and it's her parents. So there's nothing disqualified about your ex-wife's parents. So yes, technically you could do that. You could buy from them. Another question here is, does the real estate also include options in which the investor does not live? I don't fully understand that question. I think what they're saying is, could you buy property that you're not going to live in, or could you buy vacant property, maybe is what the question is. And the answer to that is yes. You could buy a property. It doesn't necessarily need to be rented. Now, most of our clients that buy property do it as an investment. Typically, if there's a structure on that property, it would behoove the investor to go ahead and rent it so they can get some income coming from the rent. But if you wanted to buy a home as a spec home or something that you're going to list at a later point, or if you want to buy a piece of land and not, obviously land doesn't have rent, so if you wanted to buy and just hold it, you could do that within a retirement plan, and that would work out fine. Another question here, if an IRA purchases shares in a C Corp that deals with real estate, can a person sell a rental to the same C Corp or purchase shares of that same C Corp? That all comes down to the ownership and control of the C Corp. And I bring that up because if you, as an individual, are the primary owner or controller of the C Corp, then the C Corp, by definition, is going to be disqualified in the same respect that you are, which means the rules that apply to you apply to the company that you own. Now, if you're a very small piece of a much bigger company and you wanted to take your IRA and potentially have a transaction with that company, you could look at that and, based on all the circumstances, decide if it's a violation of the rules. And depending on your involvement, your control, your ownership, all the factors involved, you could say either yes or no. But I'd ask you to consult with your CPA or your attorney to make sure that the company, by virtue of your involvement, is not a disqualified entity. But again, you got to kind of look at who controls the company and who owns the company. If you own or control the company is disqualified. The rules that apply to you apply to the company. Thereby, you would not have the ability to do transactions with that company. But if I'm a 5% stockholder in some big corporation that I don't control and I don't own 50% or more of, and my IRA wants to do some deal with that company, the fact is I don't own and control that company. So that company, if it decides it's in their best interest, could technically do deals with my IRA even though I'm a very small percent owner in that company. Now again, you got to look at it on a case-by-case basis because, and I'd look at section 4975 of the code and look at all of the detailed listing of who a disqualified party is and make sure that you're not putting yourself in a position where your involvement in that company would make the entire company disqualified. And quite frankly, we can give you the basic information, we can provide you the reference to the code, but that decision is for you, your tax advisor, your attorney, to go in, look at it, dissect the code, and make sure that you understand what you're doing and that it's an allowable investment for your IRA. If we see something that's clearly disqualified, John Doe selling to John Doe's IRA, we'll step in and say, wait a second, that doesn't work because it's very clear. But if John Doe is going to invest in Company A, it's really up to John Doe to figure out whether Company A is a viable company to invest in based on the rules provided in Section 4975. We can provide a little bit of guidance to that respect, kind of give you a place to look at in the code and the rules that we can clearly see listed, but that's really something you're going to want to run by your CPA and or attorney. Question here, if my husband were to buy a property with his IRA, could he rent it to my mother? It's a great question. I would say in that case, based on the account holder's situation, your husband, is your mother, his spouse's mother, a disqualified person? No, I would say no, they're not, because it's lineal ascendants or descendants and spouses of lineal ascendants or descendants. So from your husband's standpoint, his mother-in-law technically would not be a disqualified person in that case. Now, if you flip the tables, if your mother-in-law owned a property, she would not be able to rent it to your husband because your husband, in that scenario, is a spouse of a direct lineal relative, in this case you, and that would be a disqualified transaction. So again, these things get a little bit complicated, but the rules really aren't that they're not that difficult to navigate once you start digging in. You just have to look at it and say who's involved on the day of the transaction, and is anything transpiring here going to be a disqualified transaction based on who's involved. And so run that by your CPA, run it by your attorney, make sure you're not in violation of any of the rules. You can run it by a rep at Entrust. We can provide you with the basic information. If it works, we'll move forward. If it doesn't, then you can look at a different alternative. There's a question generally about how does leverage impact an IRA. Basically allows you to buy a property that's potentially larger than what you could do in the IRA. Obviously, when you leverage a property, you have a built-in expense of a mortgage payment. If you're going to finance it, you're going to have to pay that payment back to the bank out of the IRA. So instead of just having your standard repairs and upkeep type items to prepare for, you're going to have a fixed expense of a mortgage payment. And so you're going to want to make sure that you can budget that into the IRA, that you've got enough income coming in from the rent in order to pay the expense out each month of the mortgage and everything else. All right, question, it's more of a comment. We just partnered 3 Entrust clients using 5 different IRAs. That's kind of a neat thing that this gentleman was working with Entrust clients. They put together a deal. In this case, you got 5 different IRAs involved in one deal on split ownership. So again, it gets a little bit lengthy on the titling of the investment, but it's an option. Another option would be to potentially create an entity like an LLC and have those 5 individuals buy into the LLC and then have the LLC buy the property or the other investment. Let's see. These are great questions, by the way, and I'm going to try to keep it to about an hour. We're about an hour right now, and so I'm going to have to shut it down in just a moment, but I appreciate these questions. Please write down my contact information, so if we run out of time here today and I didn't have time to answer your question, you can call me at my office or call our corporate office and get answers to your questions. But I'm going to keep going until they shut me off at corporate, and I'll keep answering questions. Question here is, can I manage a property that is purchased by me and my IRA? I think the answer to that comes down to what do you mean by manage? You can certainly oversee a property. You can basically control a property. You can determine what you buy, who you rent to, how much you rent for. You could physically go pick up a rent check if you wanted to that's made payable to your IRA and then send that into the IRA account with us. That's all fine. I kind of, again, use the term overview. You can oversee the investment. But when you get into management, and particularly compensated management, you would not be able to be the manager the property manager on a property that your IRA owns. What I mean by that is you're not going to be able to go and have the tenant write the rent check to you, you deposit it in your bank account, and then you write a check to us. You're also not allowed to be compensated for anything that your IRA is taking part in. So can you oversee the investment? Yes. In fact, you probably should, because nobody else is going to take on that responsibility. You're going to control it. But management is a different term altogether, and you would not be able to actually manage the property and be compensated for managing it. You could hire a property manager, an unrelated third-party property management company, but you and your direct lineal ascendants and descendants technically shouldn't be the manager on the property that your IRA owns. Here's a question about, can I live in a property upon retirement? Well, the rules state that when your IRA owns an investment, you and your direct lineal relatives cannot live in that property. So while your IRA is the owner, you're not allowed to actually use the property. Now, once you reach retirement age, if you wanted to remove the asset from the IRA, at that point, once you removed it from the IRA, you could technically live in a property. So if you're under the age of 59 and a half and you removed it, you distributed the property in kind from the IRA to yourself, then you'd have to pay a 10% early withdrawal penalty on the distribution. If you're over the age of 59 and a half, you could distribute either cash or the property, if you wanted to, from the IRA. Now, if you distribute the property, you have to be very careful about how you value that property. You're obviously going to want it appraised by a qualified appraiser who provides a very conservative established value. But if you wanted to distribute that asset in kind without selling it, taking the asset over personally, you could do that if you document it appropriately. Now, I don't see that very often, but it is something that's an option if you wanted to look into that. Obviously, it's a lot more appealing for a Roth IRA than it is for a traditional pre-tax account, because with the Roth, distributions, if they're qualified, are not going to be taxable. So it might be a better situation, a Roth. Let's see, another question. It says, can a property owned by an IRA act as security for the acquisition of a loan? Let me kind of build on that a little bit. If the IRA is buying a property and using a non-recourse lender, the property itself can be pledged as collateral for that loan. The bank can have access to the property in the event that the IRA doesn't pay them back. Now, if you're asking if you could go buy a property personally and use your IRA-owned property as collateral for that loan, the answer is no. Likewise, you can't personally guarantee or extend your personal credit on behalf of something the IRA is doing. So with everything you do, you want to think of you and the IRA as separate entities. And really, you don't benefit from what the IRA is doing. The IRA doesn't benefit from you being around. You keep those two constructively split and keep the IRA investments IRA, keep your investments your investments. And when you get into commingling stuff, you need to be very careful on how that's handled. Okay, let's see if there's any other good questions. No, this is a long example here. It says, what about this scenario? I use an IRA to buy stock in a private placement in a company that I control. That company then purchases property. Can the company then rent the property back to me? Well, there's a couple things about that scenario that's probably not going to work. The very first one is that you're saying you're going to take your IRA and buy stock in a company that you control. Just by the way that's phrased, that's probably not going to work. Now, you could dig into, okay, who owns it and who controls it. But generally speaking, if you say this is a company I control, that company is going to be a disqualified company, and thereby your IRA could not invest in that company because the rules state that that's not allowed. That's self-dealing. And then the question is, if you bought into a company, could that company then lease back to you? Now, a lot of factors have to be addressed there. Again, you have to look at the ownership and control of the company, who makes the decisions on behalf of the company, and all of those situations. So we can talk about that kind of offline on a case-by-case basis, because there's a lot of factors that need to be addressed. We need to see who's who within the entity, who's who within the transaction, and then kind of dig into it. Ultimately, that's between you and your tax advisor, but we can kind of point you in a direction as to what may work and what may not work. Question is rent. How is rent handled? How is it paid? It's paid to the IRA or to the owner of the investment. So if the IRA owns 100% of the property and there's a rent check, the rent check's going back into the IRA for 100% of the rent. If the IRA is a part owner in the property and there's more than one party involved, the rent's going to be split between the two parties that own the property. So it may be partly owned IRA and partly owned non-IRA, in which case the rent check would actually be split to 2 different parties or 3 different parties, whatever the situation may be. There's a follow-up to that question is how often is the rent paid? Is it monthly or yearly? That's really between you and the tenant. That's something for you to negotiate with the tenant, what they're going to pay, how often they pay. Those are all items that you're going to address directly with the tenant. Typically it's monthly. I mean, I rent a house and I pay my tenant, I pay my landlord once a month on the first of the month, but if you want to negotiate something a little bit different, you could potentially do that, and it'd be between you and the tenant. There's a question about asset protection. How do I become anonymous for asset protection purposes? We don't really get into telling you how to provide asset protection because, quite frankly, that's something the attorneys need to address. There's different people that would say that an LLC is a better asset protection vehicle than buying through an IRA directly. Sometimes clients have asked that we remove their name from the vesting, so we just have their IRA account number as opposed to their name and account number. We're a little bit flexible when it comes to that type of stuff. But again, that's something that's between you and the attorneys and how you want to structure the deal. That's not something for us to advise upon. I got a lot of questions here, and I'm just not going to have time to go ahead and finish them. We try to keep these presentations to 45 minutes. Inevitably, we always run over because there's content that needs to be addressed and questions that come up. What I would ask is for you to jot down my name, contact information, and email. And for the questions that have been posed that I haven't had time to answer, just shoot them to me in an email. We can talk about it offline. In fact, a lot of times we can get a little more in depth talking one-on-one about your specific situation. That's one of the benefits of having local reps in the field is that we can talk about your deal and what you're trying to do. I apologize for the people I didn't have time to answer questions. I probably should have shortened down my portion. I didn't realize there would be quite this many questions, but I encourage it. I thank you for taking the time to join us today. For those of you that are looking to get a playback, we will provide you with a playback recording that you can listen to at a later point. You could also share that with other people if you're interested. But here at Entrust, this is what we do. We are self-directed IRA administrators. We've been doing it for 31 years. We love the industry. We enjoy talking about this stuff, and we want to make sure that if you decide to go down this path, that you have all the information and knowledge that you need to both decide you want to do it and then do it appropriately. So please use us as a resource. Please ask us any questions. Go to our website. Contact me if I can be of assistance. And again, I thank you for taking an hour of your time to join us for the webinar. Hopefully it was worth your time and energy. And again, if we can help in any way down the road, please don't hesitate to contact us. Thanks again for joining us. We'll go ahead and shut it down for today. Take care.
Thank you. Please stand by.